Hi guys, I'm EP. In this video, we are going to see an investing strategy in bonds. The strategy is bond laddering. Okay, let's get started. Okay, what is a ladder? A ladder is nothing but a series of steps which is aligned equally to each other. Likewise, in bond, we are also going to select a series of maturities and we are going to invest it in a series of time intervals to achieve our financial goal. Okay, let me explain. Okay, basically, it is a ladder. The ladder which has a series of steps, but it is always aligned in a equal distance between one and another. Likewise, in the bond laddering, we are going to invest in the bond which has a maturity of 1 year and 2 year and 3 year, 4 year, 5 year. Rather than we are going to invest our all the money in this invest in the bond which has a single maturity, rather than we are going to divide it and we are going to invest in a different types of maturities but with a constant intervals. Okay, now let us assume we have investment value of 5 lakh rupees. As per Graham's rule, an individual investor should not have a bond more than maturity of 5 years period. So that I'm considering we should have a 5 year maturity. Okay, and we should divide the 5 lakhs into 5 1 lakhs and we should invest 1 lakh in a bond which has a maturity of 1 year and 1 lakh which has the maturity of 2 year and the another 1 lakh which has the maturity of 1 year and so on till 5 years. Okay, it is the bond laddering. Okay, while doing this, at the first year our principal amount plus the interest is paid out to our account, so that if we have any emergency need, then we can use the principal and the interest amount. If we don't have any bulk expenses, then we can invest that bond at the next year. Okay, at the end of the first year we have the 1 lakh principal plus the interest, and after that we are going to invest that bond which has the next 5 year, that is sixth year. It is the bond laddering strategy. Okay, now let us see the advantage and the disadvantage of bond laddering. Okay, for that, now let us consider the inflation in the economy, let's say 5%, and we are going to execute the strategy for next 5 years. Okay, basically, if the inflation is 5%, then we are going to invest in the AAA bonds or government bonds. Okay, relatively, the government bond will offer us a extra 1% to the inflation in the economy. That, let's say, 6%. Okay, basically, our investment will look like this. The inflation in the economy is 5%, and our goal is to, and we are going to invest it for the next 5 years. And if the inflation is 5%, then the government bond or a AAA company bond will offer us a 6% return. Then our investment will be like this. I'm saying this, I'm just taking this for an example. If the long dated bonds will always offer a slightly higher interest than the short term maturity bonds. Okay, now let us consider in the economy the inflation is rising. Okay, the next year, let's consider the inflation rose to 7%. Okay, at the first year, then we have our 1 lakh plus 1 lakh plus our 6,000 rupees, that is 6% interest. Okay. At the second year, now let us consider at this now we are going to ladder our bond. Okay, now if the inflation rises in the economy, then the government issue bond will, if let's consider if the inflation rises 1% in the economy, then the government bond will offer us a 8% interest to attract the investors to invest. Okay, now due to the bond laddering, we are going to invest that money in the 8% of interest. Let's, it is the sixth year and we are going to invest 1 lakh with the 8% interest. Okay, it is the advantage of the bond laddering. If the inflation keep on increasing in the economy, then our investment, if we are going to a seventh year in the economy, there is an increasing in the inflation, then the government bond which will also increase their interest rate to attract the investors to invest. Okay, then by using the bond laddering strategy, we can invest our money at what percentage the government is offering today. Okay, it is the main advantage while investing in the bond. The main disadvantage is the vice versa. Now let's consider if the inflation decreases in the economy. Let's say at the second year the inflation drops to from 5% to 4%. Then at the second year the government will offer us only a 5% of interest for the new public issue bond, so that we tend to lose our money relatively. In case of if the inflation keep on dropping, then in the bond laddering strategy we tend to lose our money. Okay, now we have two options. First thing, we can accept our loss and we can invest our money, or if we have further opportunities in stock market, we can move our fund to that. Okay, it is the advantage and the disadvantage of bond laddering. If the inflation keep on rising, then it's advantage for bond laddering. If the inflation keep on dropping, then it's a disadvantage of bond laddering. Okay, before executing the bond ladder strategy, we should know the three main things. The first thing is we should invest in the bond which has a high rating. Simply, we should invest in the government securities that has a zero default risk. Okay, the second one is we should have the mindset of we should only sell the bond at the maturity. If we sell the bond in between the maturities, then whole strategy will collapse. Okay, and the third one is the previous example, we have seen the 1 year gap between the previous bond and the current bond maturity, but we can also widen our gap, like 2 years from the current bond matures, we can leave a 2 years gap for the next bond matures and for the 2 years, like so on. According to our investment goal, we should select our time period and we should make sure that we are only investing in the government securities. If you are going to invest a lot of money, then I always suggest you to go with a professional who handles the bond investing. Okay. Hope you enjoy watching this video. Till next video, stay tuned. Thank you.